Hello everyone, this is Dr. Mihir Shah once again with another video. In this video we are going to learn how to calculate sum based on long-term capital gain. Again, a very important and a very simple sum. Before starting the sum, we will first note down the format and I'll explain some rules on it, and thereafter we can start solving the sum based on long-term capital gain. So let us see the rules and thereafter how to solve the particular sum.
Okay, now this is the format for solving the sum based on long-term capital gains. The sum will start with number one, sales consideration. That is the value at which you're going to sell your property in the previous year. Less brokerage or transfer fees any. So you minus from your sales the brokerage, you will get our answer as a net sale consideration. Now from net sale consideration, number one, you have to subtract something called as indexed cost of acquisition. It means we need to find the cost price of the property if it would be purchased in the previous year. The formula is cost of acquisition into CII, that is cost inflation index of previous year, upon CII of the year of acquisition. So this is one formula, very simple formula. Practically when you'll do it, will be having a bit more weightage. You'll understand very easily what is that formula all about. After subtracting index cost of acquisition, the next thing is less index cost of improvement. Again, the formula is similar. Cost of improvement into CI of previous year upon CI of year of improvement. Improvement means if you're doing any renovation on your property. So for with that, you can ask for some exemption, or you can say some deduction on the value of your sale. When you subtract your index cost of acquisition and improvement from your net sale consideration, we'll get a first answer called a long-term capital gain. And if after that, if there is any new purchase or new investment made, we will subtract that also, and the final answer what we will get will termed as long-term capital gains. Very simple sum, just 4 to 5 steps and the entire sum gets done. Now before solving the sum, okay, there are a few rules that we need to note down. Number one, 2001 will be called as a base year. If any house is purchased before 2001, do not consider that value. Consider the fair market value as on 1st April 2001. The improvement before the year 2001 should be ignored. And most of the, it's that the cost of acquisition will only be once in the question, but improvement can be multiple times. Okay, can be more than one time where you can have your improvement in the sum. Okay, those are the basic rule that has to be remembered. The only thing what you need to know is the format is sale less cost of acquisition less cost of improvement gives you long-term capital gain. Less new purchase will again give you your final answer as net long-term capital gain. Chalo, now let us see how to use this format into any sum, any kind of sum that will be given in the exam.
Okay, now let us see how we solve the sum. We go through the question first. Mr. Raj acquired the house property on 1st March 92 for rupees 2 lakhs. The fair market value as on 1st April 2001 was 2,40,000. The cost of improvement made are as follows. They are giving you 4 improvement: 94-95, 2006-7, 15-16 and 16-17. He sold the house for 1,80 lakhs on 25th Jan 2022, that is our previous year. He acquired new house in the previous year for 58 lakhs. He invested rupees 15 lakhs in bonds in the previous year, and there were some transfer expenses of rupees 75,000. The question is given that you need to compute the long-term capital gain for the assessment year 22-23. The CII are given for various years. That's nothing but the cost inflation index. Now let us see how to solve this particular question. Okay, first the name. We'll note the name as Mr. Raj. His status is he's an individual. The previous year will always be 2021-22 and assessment year will always be 22-23. Computation of long-term capital gain, particular amount. The sum will always start with sales consideration. How much are you selling your property for? So it's given here, he sold the house for 1,80 lakhs. So that's 1,80 lakhs. Less brokerage or transfer charges. So here our brokerage is given here. The transfer expenses was 75,000. So we are going to less 75,000, and that amount what we'll get will be known as net sales consideration. So that will come to 1,79,25,000. Okay, after this our first step is less indexed cost of acquisition. Acquisition means purchase. Okay, so now let us see how to calculate that. The formula is very simple. Cost of acquisition is how much you have purchased for. Is given here. You had Mr. Raj had acquired the property for rupees 2 lakhs in 92. Now the rule was, if a property is there before 2001, we cannot take that value. We'll have to always take the fair market value as on 1st April 2001, which was rupees 2,40,000. So our cost of acquisition is 2,40,000 into, we have CII of the previous year. Now previous year was 21-22, so the CII will come to the CII table. We can see it's 317. So 317 upon CII of the year of acquisition. Now this amount was taken from the year 2001. So 2001 ka rate was 100. So now you multiply and you divide, and that value will be known as our cost of acquisition, which comes to that value will be 7,60,800. That's the first part. Next, less indexed cost of improvement. Improvement is all the renovation that have been taking place on your property. The rule is before 2001 we cannot take that, we have to ignore that. So I can see your improvements are given. So this is before 2001, ignore it. We'll take the first, that is for the year 2006 and 7. Improvement is 1,20,000. The rule is into CI of the previous year, which is 317, upon the improvement of the year in which it was taken. This is 2006-7. 6-7 ka rate was 122. So you divide and you multiply and divide, and you will get your value as 3,11,803. Same way, second improvement, it was 4 lakhs into CI of the previous year, which is fixed 317, upon the year of CI was 15-16. So 15-16 was 254. So the value will come approximately 4,99,213. And third, we have 3,80,000 into 317 upon, this is of 16-17, the rate is 264. So the value will be approximately 4,56,288. You subtract them all and you will get our first answer, that will be known as long-term capital gain from the net sales. So it will be net sale less. Remember, from top to bottom each and every values will be less. So the value that you all should have got would be so it would be 1,58,96,896. This is known as long-term capital gain. From this we will less new purchases. I can see here is given he purchased a new house. So new house, which is 58 lakhs, and new investment, if any. So here is saying new investment in bond. I can see here you have invested 15 lakhs in bonds, so we'll minus even that. So from top to bottom, the only thing what you'll have to do is subtract. So from your long-term capital gain, when you subtract the other two values, you will get a final net long-term capital gain, which comes to approximately will come to 85,96,896. So that is how we need to solve the sum, which is based on long-term capital gain. So here we had cost of acquisition, cost of improvement, there were multiple, and also we had something which was purchased and some amount which was invested. This is how you need to solve the sum based on long-term capital gain. This was the first example. We'll be doing another example also. Okay, now let us see the next sum. Raj purchased a house on 25th 698. Now this is before 2001 for 1,50,000. He incurred expenses of rupees 1,50,000 toward cost of improvement on 28/2003. The fair market value as on 1st April 2001 was 8 lakhs. He sold the house in the previous year for 95 lakhs. He purchased a new house for rupees 2,50,000 on 20th March 2022. We'll make this as 25 lakhs. We'll keep this as this. This is 25 lakhs. And the CIF was 2001-2 is 100, 2003-4 is 109, and for 21-22 is 317. Compute the long-term capital gain. So again, name we'll write it as Mr. Raj. Status is individual. The previous year will be 21-22 and assessment year will be 22-23. Sum will always start with sales consideration. That is, what is the amount at which you are selling your house. So here it is given that the house was sold for 95 lakhs less brokerage or transfer charges. Now in this sum we went through the sum but we didn't see any transfer charges, so it's nil. So our net sale consideration will be 95 lakhs. Now comes first less indexed cost of acquisition. Now index cost of acquisition may you will have to first take the value of your property. Now you have purchased it for 1,50,000, but that was in the year 2000. Sorry, it was in the year 98, which is not possible to be taken. So we'll have to take the fair market value as on 1st April 2001, which is 8 lakhs into 317. That is by default because previous year CI is always 317 for the year 21-22. Now this rate was taken, the amount was taken in the year 2001, so the rate is 100. So we multiply, we divide, and we'll get the index cost of acquisition as 25,36,000 less indexed cost of improvement. Again, this is for your renovation, so we can see that there's one improvement made in the year 2003 for 1,50,000, so that will be 1,50,000 into 317 upon 2003 ka rate is 109. Again you multiply, you divide, your value will be 4,36,239. Now there's only one improvement in this sum, so now we'll subtract from our net sale, and the value that we should get is our long-term capital gain. So 95 lakh minus both these values will come up to 65,27,761. From there, less any new purchase or investment. So we have purchased a new house, so less new house, which was 25 lakh. So when you subtract, you will get a final answer as long-term capital gain or net long-term capital gain, which will be approximately 40 lakh 27,761. So this is how we need to solve the sum based on long-term capital gain. I hope everyone have understood.